Good morning, it's Christian Thwaites from Brown Janikowski. Tuesday, October 11th, the day after New World Day, which is one of those odd days in the calendar where some markets are closed and some aren't. In this case, the fixed income market was closed, which means that the new job numbers which we got on Friday, the market didn't have fully time to absorb it. So let's see what's going on, because this was a very interesting and important set of numbers. So this chart here shows the non-farm payroll numbers. These are the blue bars, and you can see that the average for the last couple of years has been about 200,000. It's now, the last number on Friday was 156,000. So a little bit of a rebound from those dreadful numbers that we saw just a few months ago. And the other chart is interesting. It's the orange chart, and it's beginning to show that hourly earnings on a year-to-year basis are sloping up. It's a bit jagged and a bit volatile, but you can see that in the middle of 14, the number has come gradually up, and we're at the last number was about 2.5%. So what does this mean? Well, whatever you think about the labor market, this chart confirmed it for you. For the Fed, it was an indication that payroll is alive and well. The job market is doing well. Unemployment numbers ticked up a little bit to 5%, but not enough to worry about from the Fed's point of view. And then the hourly earnings is coming through, and that's more of an indication that there might be some inflation in the pipeline. If you're of the belief that the employment market is still pretty weak, then these numbers also gave you that, because the 156,000 number included a lot of temporary work. And it's also well below the trend that we would expect given population growth. So where are we? Well, the market typically doesn't really know what to do with this. And today, Tuesday, we've had equities pretty much flat. There's been some noise. And bond markets came up off a little bit by about 10 basis points, with the key 10-year Treasury rate trading at 1.7%. So the market, I think, is sort of really not ready to take a big position on this. Obviously, there's a lot of other noise in the market right now. First and foremost, of course, the political debates, which really no one quite know what to make of, and huge amounts of uncertainty there. And then also on Friday, we saw an indication just how skittish some of these markets can be when we saw sterling plunge in a flash crash, classic flash crash, of about 6 or 7%. It's a very big market, so very unusual. For something very odd happened in that market for it to be affected so much. So markets will be a little bit skittish between now, certainly, and the election. It's not necessarily time to take money off the table, and we kind of like the fact that it's going to be sideways for a bit. That gives us a chance to sort of take some ground in and think about where we want to go next. So we're looking for the next big items on the news calendar are going to be earnings, and we're fairly positive about those. We wrote about them in our blog last week. Thanks very much.